It makes a lot of sense, Tyler. It makes a lot of sense, in part because, in general, there hasn't been a lot of build-out in this business cycle because credit's been tight. People's credit histories have been poor, so it hasn't been the overbuilding that has typically categorized past booms or past economic expansion. So if mortgage rates fall, and they fall much further, as I expect they will, housing should do very, very well.
Is the slowdown that the yield curve is signaling more a reflection of last year's and the year before that's monetary policy or the trade tensions? Which is it?
It is monetary policy. And I'll give you one example, Tyler. The weakest part of the economy, the single weakest part of the economy, is construction. It's weaker than consumption, any category of consumption. It's weaker than CapEx, all the categories. It's also weaker than exports. And that is a function of the fact that rates last year went up relatively high, the highest they'd been in almost 8 years. So it's not trade. It might be trade at some point. It's really all about the Fed.
You say that the yield curve needs to uninvert. Well, that's easy to say. How do you get it to do that?
Very easy. Powell should have read a lot of the things I wrote, Tyler, which said they should have moved 50 last month and not made that gaffe about a mid-cycle adjustment. So now we'll come to the September 18 meeting. Depending on where the market is, they should go 50. I might argue for a 75 basis point cut. You basically do more than the difference between the Fed funds rate and the 10-year note, which back in July was about 30 basis points. So they had to cut more than 25 to uninvert that 30. And depending on where we are next month, they may have to do upwards of 75.